Welcome to Coleman Report Live. I'm Bob Coleman, and we're talking Main Street and the small business lenders who help it grow. But not today. We're going to talk about what is going on, and I'm gonna go with Lance first. Lance, you've seen some of these in the past. Let's look. Our job's to put this in context. We're gonna take 20 minutes. So Lance, go. How does this rate other crises, financial crises you have seen over your years in the business?
Well, it's a different situation in that, the reasons for this bank's failure is not similar to the reasons of bank failures in the Great Recession. I actually worked bank failures in the early 80s. I also worked them in 2009 and 2010, and the cause is completely different. But as I was sharing with John, not many people have seen a run on bank deposits. I actually have seen customers lined up at a bank to withdraw their money back during those time periods. Thankfully, the Fed has stepped in and provided some assurance that people are going to get their deposits back, especially those over $250,000. But it's a very interesting time. This was a very large institution compared to some of the bank closings that I've worked, Bob. And, it didn't have anything to do with their lending, nothing at all to do with their lending. It just, we live in a time when somebody can see an Instagram post or a tweet or something online that says why this bank is in trouble, and then suddenly customers are showing up saying, I need my money. And
you're absolutely right, Lance. That's a significant difference between today and 2008, where social media, it just blew up. And it was
and it happened very quickly. I know in my reading about this situation, middle of the week, things were not looking so bad. And then by, Wednesday, there was some sort of an announcement on Wednesday. Investment advisors were telling their customers, maybe you should get your money and move it. And it caused a run on the bank. And of course, the bank has no option here, with the exception of selling some of the investments they put the deposits in. And, a typical bank takes deposits and lends those deposits at, everybody on this call knows this. The bank gets a deposit, pays 2 or 3%, and turns around and lends it at 8 or 9%. But in the case of Silicon Valley Bank, they didn't have a loan appetite to cover all those deposits, so they put them in government bonds. And when interest rates went up, government bond prices went down, and it was a perfect tsunami in this situation. But, my final comment, Bob and John, this is very different from what I saw back in 2009 and 10.
John, so Lance has sort of set it up, and it's different. First of all, the first question is, Washington just responded, and number two, is that response going to be sufficient to calm the seas?
I guess I should try to stay out of the prediction business, but I'm going to disregard my own instincts and jump right in. I think it will be. I hope I don't look like a moron tomorrow or later today or 5 minutes from now, because as you said, things move very fast.
Right.
But I think it will, because Lance touched on one point that sort of caused the downfall or precipitated the downfall of Silicon Valley. Had to sell their investments at a loss, and the Treasury program is accepting those investments at par value. So, and banks are pledging them as collateral. They're not having to turn them over to the Treasury. So banks can get the loan that they need, the liquidity that they need now, and still hold on to those investments, pay the Treasury back, and everything will hopefully work out fine. The other thing that struck me about that program is the loans are 1 year in duration. So it's not like TARP, if you think back. The Treasury Department, obviously, one can infer from that that they do not see this as a long-lasting problem.
Yeah, and they're kicking it up. John, I agree with you. I agree with you on a couple things. Number one is, put it in context, you have a $1 million house, and all of a sudden the house is now worth $500,000, but because of market things, even though nothing has changed in that house, but you can go to the bank and they'll still give you $1 million for that. So some people call that extend and pretend and extend, but I agree with you. I think it's going to solve the problem. And obviously you're going to see, to protect the community banks and these mid-regional banks in the future, they're going to have to raise that deposit limit. It will happen. I want to talk about SBA in a second, but one of the things that shocked me about this is, in reading through what was going on, there was no credit risk manager at this bank. I was astounded at that. John, what do you think about that?
Well, I think they did have a risk manager, and there's been a lot of talk about the fact that she was involved in some other activities as well. I don't want to get into that, but there was you have to call it in retrospect, sort of a catastrophically bad decision made. And Lance, you touched on it. You said they would, because they didn't have what they felt were enough loan opportunities, they were investing in securities, but they invested in long duration securities.
Yeah.
And they had nowhere to turn when the economy went bad. And not only, are they stuck with these long duration securities, but they're not worth as much as they were before because nobody wants them. And to sell them, you have to take a loss. And that was the loss that obliterated their capital. And then they tried to, have a recapitalization, but that deal very quickly fell apart. And
yeah, but I just don't understand, John. There was no adult in the room that said, "What are we doing?" I don't think any of the three of us would have approved that. I find that incredible. But anyway,
well, I'd like to throw in one thing in here. I'm getting way ahead of my skis. Maybe talking about something I don't understand. Lance will probably correct me if I go crazily wrong on this, but I just wonder if there was a way the government couldn't have intervened before this happened in a way that could, I'm sorry.
No worries.
The way they could have saved Silicon Valley and avoided all this heartache.
Yeah.
But that goes back 2008, 2009. Are we going to save Bear Stearns? Who are we going to save? Who are we going to let him go down the tube? Lance, so how does this affect small business lending?
Not really at all. SBA lending in difficult economic times tends to be very strong. In times when banks are tightening their commercial lending policy, SBA tends to be the product that continues to be in demand during tight lending policies. I like what the Fed did, stepping in, ensuring the depositors would get paid, because my biggest concern was, could this possibly flow over to normal banks? And I hate to use the word normal, but, could depositors get nervous at a regular bank that takes deposits and lends those deposits? But in terms of small business lending will remain strong. The impact of this is going to be negligible. And I think the Fed did the right things necessary to kind of put a stop to this, because I think they saw the writing on the wall. One of the things I saw immediately after this happened was there was a release of all the banks in the country that gave the percentage of their depositors that had in excess of $250,000 in their accounts. Those banks potentially, those depositors could have immediately said, well, what do we do? In that situation. But I think the Fed stopped that potential problem. And really, I don't see these closures as having an impact on SBA lending. SBA lending will remain strong because of the demand for it.
Well, I would almost go the other route, which is the bank was looking for yield SBA lending has a very nice
Oh,
yield
yeah.
for lenders. If banks are looking for things that yield, you're looking for niche lending opportunities, and bam, SBA is right there.
Absolutely, Bob. Yeah, like I said earlier, in times of tighter lending policies, SBA lending's strong. In
Yeah.
times of economic difficulty, SBA lending's strong. So
That's
it
a
should
great
be.
question. With Signature failing, they're one of the, they were caught up in that crypto thing, I believe. John, correct me if I'm wrong on that. Is that, okay, you're nodding your head.
Yeah, well, they had a significant amount of deposits from crypto, and right now deposits are so important to banks, and the loss of those as people lost faith in crypto, obviously sort of crippled Signature.
My answer to this is it's not going to have an impact. There are enough players out there. This isn't a situation where they're a market maker. No one, and that's not a derogatory term. There's no one lender that sets the market. It is competitive, and it's still spread out by a number of buyers. And that market, while the yields are down, is still strong. I mean, what would you rather buy, John, if you're a bank risk officer? You want to buy a flat 30-year treasury at 2%, or you want to buy government guaranteed loan portfolio that floats with prime?
I would go with the government guarantee.
Go door two.
Well, Bob, I don't think it has a long-term impact on secondary market sales, if any impact at all. But there could be buyers who buy SBA guaranteed loans who may take a brief pause, if that makes sense, just to assess the situation. But I think long-term, no impact.
Yeah. Deposit flight is something run on the bank. That you're talking a 1930s concept, John. Do you agree with my assessment that something will be done to raise that 250 so we don't have this situation in the future?
Well, that'll be a very interesting discussion, because I've seen some commentary questioning why we bother to have this legal limit if the government is going to step in.
Going to bail us out, right?
Yeah.
But if they do decide to eliminate that limit, and they want money to remain in the banking system, they want it there. They're going to have to. I would imagine they're going to have to raise the price of deposit insurance. Right.
Or have a government line on that. This is one thing that I found interesting, and it was a quote. It said, Biden fired, and then the quote was, Biden fired all the executives at the bank, which is at both those banks, which is interesting that if the government wants you out, they're going to figure a way to get you out.
Bob, the thing that's interesting about this coming up is I've been on the other side of the teller line representing the FDIC with checks for the prospective borrowers after a bank closed. I mean, it causes a great level of anxiety with the individuals who have money in that bank, but when they get their check, they're like, oh, okay. And somebody, I haven't seen, but typically in a situation like this, another bank steps in and takes over. For a short period of time, FDIC will operate it as a banking institution. Checks ought to flow in and out as normal, but it does create a lot of anxiety for the people who are customers.
Of course. John, did you see that they sold off the English regulators? And I confess I know nothing about that process, but they sold off Silicon Valley Bank's assets to HSBC. Did you see that?
I did see that, and
for how much?
I didn't see that. So, $1.
Which,
it's not a bad bank.
Yeah.
It's no fun.
It'd be the best dollar they ever spent, or the
Probably.
or the worst. Well, very good. So I want to recap then. I believe the mistakes were by the bank. It's not a systematic failure in terms of affecting the economy. Number one, the bank was reaching for yield by going for those 2% long-term treasuries, which was a horrible, horrible mistake. They wanted to invest their assets. Obviously, they felt they had too much cash, and they should have been prudent businessmen by saying, hey, what are our options? And they should have looked for other lending opportunities. They were certainly concentrated in the tech field. And this just goes back to prove rule number one is diversify yourself, because you don't know what's going to happen.
Well, it's a great example, Bob, of a bank whose balance sheet got out of whack. And, there are a lot of banks that dealt with significant levels of deposits because of what happened during the pandemic. Right. The federal government flushes billions and billions of dollars into the system, and a lot of that showed up in the form of bank deposits. So banks had to find ways to deploy those deposits. There are a variety of ways. There could be investments like bonds, there's loans, and other ways you can deploy the money, but their balance sheet got out of whack.
Yeah, and that's the risk management situation. Last comment, or last thought I want to address are future interest rates. What little I read, John, it says that interest rates, the hikes that we were talking about on last Wednesday aren't going to happen. Again, we're in the speculation business. Why don't you just report on what that looks like?
Well, that is the conventional wisdom now, and conventional wisdom is looked down upon for a reason. I mean, think about it. There was a lot of talk at the beginning of the year that rates were going to moderate, that after the significant tightening in sort of historic tightening throughout 2022, that after a couple more hikes in the early part of 2023, by mid-year rates would start to moderate and even go down, and then that dissipated, and last week before this all got kicked off at Silicon Valley, they were talking about how expect rate hikes for longer, and now a week later we're talking about at least one meeting that there's going to be no rate hike,
no rate increase, which is positive for SBA lending, right, Lance? If the
absolutely.
borrower feels that we're through raising rates, okay, I'll do the SBA 7A loan. Go ahead.
Well, borrowers certainly need some relief in terms of, last year most borrowers' rates doubled and their payment levels doubled. So relief in terms of a little bit of stability in what their payment's going to be is a good thing.
Very good. I need to make a correction, gentlemen. I was wrong. It was not $1. It was £1.
1 pound.
1 pound. Just so you know, I misspoke.
$3.
I don't know what the conversion rate is these days, but it is a 1 English pound. Lance, what are you talking about next Wednesday?
So we're going to talk about...
you're tore it up and you have to start all over now. Go ahead.
Yeah, we're going to talk about servicing actions that are challenging for SBA lenders, things like relief of guarantors, relief of or release of collateral, release of guarantors, restructuring loans. And we're also going to bring up, Bob, something that may come up, the offer and compromise. And how do you navigate an offer and compromise with SBA? All very relevant things in today's economic environment.
Gentlemen, great conversation. John, thank you very much for your time. I know you're busy with your real job. So, and Lance, I'm going to see you on Wednesday in San Diego, Coronado.
I am hopping on the American Airlines flight to San Diego tomorrow afternoon. So,
and I'm sorry to say, do not bring your, it's going to be raining both days.
Oh, goodness. Well, I'll bring a rain jacket.
Thank you for joining us today for Coleman Report Live and for supporting America's Main Street, one entrepreneur at a time.
Have a great day.
Thank you for joining us today for today's episode. If you like today's content, hit that subscribe button to subscribe to our channel and click that bell icon to get notified about our latest videos. Thank you again for joining us today and for supporting America's Main Street, one entrepreneur at a time. Catch you next time.